Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last video, we applied our valuation matrix to the Mega 7. Today, we are expanding our wish list to look at 7 highly requested companies across semiconductors, enterprise software, streaming, and retail. We will be analyzing AMD, TSM, Broadcom, Costco, Eli Lilly, Netflix, and ORCL. More importantly, today we are bridging the gap between valuation and execution. We're going to directly apply the entry and exit mechanics from section 1.8 of our course, specifically looking at left side buying, right side momentum, and when to use dynamic trading stops to protect your capital. Before we dive in, please note the disclaimer on the screen. This is an independent educational project. The views expressed are my own, and this is strictly for educational purposes, not financial advice. For those who want to study the underlying mathematics of these models, please refer to sections 1.7 and 1.8 of the main Quant Lab course. For our new viewers, let's quickly establish how to read this dashboard. We map out a stock's fundamental gravity using 3 core segments. Range 1, the blue box. It is the deep value floor. This is absolute fundamental support. Range 2, the red box. It is the expected target. For long-term investors, this is the range we care about most. To instantly gauge a stock's valuation, simply compare the current price to the midpoint of range 2. Then, stat range, the purple box. It is the micro-statistical boundary. This uses a P plus and minus 1 standard deviation band over the last 90 days to show us the immediate short-term momentum. Crucially, at the bottom of each matrix, we track 3 specific dates to prevent us from trading on all obsolete data. Last report date is the date the new list financial report was released. This establishes our current static APS gravity. Next report date is the date in the next earnings report is due. This reminds us exactly when our baseline estimates will violently expire and require updating. Third, analysis date is the exact live date we run the statistical P plus and minus 1 SD method. Because short-term statistical bands shift daily, you must know how fresh the macro range is. Okay, this file will not be published, but feel free to screenshot. Before we look at the valuation matrix for our first 2 companies, AMD and Broadcom, I need to point out a unique feature on their dashboards. For these 2 specific stocks, I have included a second expected range labeled GAAP target in an orange box. You might be wondering why I'm showing this here, but not for companies like Costco or Netflix. The answer lies in how these specific businesses operate. AMD and Broadcom are high increment, aggressive growth technology companies. They scale and compete through two main avenues: paying top-tier engineering talent with massive amounts of stock-based compensation and executing multi-billion dollar uh, acquisitions, like AMD purchases Xilinx and Broadcom purchasing VMware. Under strict GAAP accounting rules, these are recorded as massive, heavy expenses, which heavily weights down their official EPS. Wall Street analysts prefer to use non-GAAP numbers, which essentially strip out and ignore these expenses to paint a much rosier picture and justify much higher price targets. In this quant lab, where baseline is always strict, audited reality. However, because the gap between reality and Wall Street's adjusted hype is so extreme for these specific high increment companies, I'm providing both ranges. I want you to see exactly where the fundamental floor is and exactly how much of the current price is being supported purely by adjusted Wall Street expectations. Let's get into the analysis. Let's start with AMD. The current price is 193.39. Look at the purple stat range. AMD is currently trading below its 90-day lower statistical bound, $200, indicating short-term exhaustion. More importantly, look at the fundamental boxes. The price is sitting comfortably above our strict historical range 2 ceiling, $173, but well below the newly calculated GAAP target mid-level. So the insight is, AMD is in a fundamental tug of war. It is expensive by historical standards, but starting to look reasonable if we factor in its aggressive forward GAAP projections. So this is not a classic left side value setup yet. For true value accumulation, we would want to see this price bleed closer to the 146.56 mid-level of its historical range 2. Okay, moving down to Broadcom, AVGO. The current price is 322. Notice where the price sits. It has fallen below its 90-day stat range and is resting exactly on the ceiling of our strict range 2 target, 319. It is also at the very bottom of the orange GAAP target. So the insight is Broadcom has shed a lot of its recent momentum premium and has finally returned to test its fundamental macro ceiling. So for long-term investment, it would be much better to wait until it comes back down to around the 271 level before initiating a position. Sorry, I paused the video because I found the typo for this part. I actually used the non-GAAP for the Wall Street's target. So I should type non-GAAP for orange box and non-GAAP here. And the numbers were correct, but just the typos. And same as AMD, these are the non-GAAP targets. Well, which is the Wall Street's target. But again, we always, if you want to use the left side buying strategy, we should always wait until at least the midpoint of the range 2 to be more safe. All right, so let's move to the next one, the Costco. The current price is $1,008. Costco's chart is completely disconnected from our fundamental matrix. The absolute selling of range 2 is 632. The price is trading hundreds of dollars above that, sitting near the top of its purple momentum box. So the insight is that Costco is a fundamental company and it often acts as a hedging stock, meaning people aggressively buy it as a safe haven when the broader market goes down. However, mathematically, it is trading in the stratosphere. This is where we apply the aggressive position overlay rule from section 1.8. So, left side buyers must not touch this right now. If you already hold Costco, because the price is sitting at the massive overvaluation premium, you must implement a strict trailing stop loss to protect your capital. Do not let the momentum reversal drag you all the way back down to the fundamental floor. Next, is Eli Lilly. The current price is $9.85. And like Costco, Lilly's massive price tag is actually supported by its fundamentals. The price is sitting very close to the mid-level of its range 2 expected target, 951, and is slightly below its short-term purple stat range. So the insight is that Lilly is perfectly tracking its fundamental gravity. Its massive earnings growth is mathematically adjusting its high share price. So it is trading at fair value. A disciplined left side accumulator would to look for a dip closer to the 791 floor to begin scaling in. Let's look at Netflix. The current price is $95. Netflix is testing the absolute selling of its red range 2 expected target, $93, and sitting right at the mid-level of its purple stat range. So Netflix is technically stretched relative to its current earning baseline. It is transitioning from a fundamental value play into a pure momentum right side trade. Similar to Costco, if you bought Netflix lower in the red box, now is the time to apply a dynamic trailing stop like the R5 heuristic we covered in the course. Protect those gains in case it gets rejected at this valuation ceiling. Now, next, we have Oracle. The current price is 155. Look very closely at this chart. Oracle has completely broken below its purple stat range, and more importantly, it has broken below the floor of its red range to $175. It is currently seeking towards the deep value blue box. The insight is that this is a textbook left side value setup on the chart. However, I must warn you, stocks come down for a reason. The market has aggressively sold Oracle off, creating a massive mathematical discount relative to its historical earnings power. So, if after completing your own research, you believe that the company is truly undervalued and the sell-off is an overreaction, you could apply the 1 to 3 inverse pyramid rule. This is the zone to initiate a 1/6 filler position to prep for support, keeping capital in reverse in case panic drives it deeper. Finally, let's look at TSM. The current price is 338. This is a beautifully balanced chart. TSM is trading right inside its purple stat range and perfectly hovering near the mid-level of its red range 2 target, $323. TSM is currently trading at most perfect fair value based on our macro expectations. So for a strict left side value buyer, the math tells you to remain patient. Wait for a broader market pullback to bring it closer to the 244 floor before trying to accumulate heavily. That wraps up our analysis for today. To summarize our findings through the lens of section 1.8, Oracle ORCL is currently flashing the strongest left side value setup, offering a steep discount. If you believe in the long run thesis, conversely, stocks like Costco and Netflix are prime candidates for strict trailing stop losses to protect against their current overvaluation premiums. I plan to update about 7 stocks every weekend to keep our dashboard fresh and relevant. If you want to master this entry and exit mechanics yourself, all the notes are available in the Quant Lab. Thank you for watching, and I will see you in the next section.